Welcome back to Investing Talk Podcast.
Today we're looking at this particular oil and gas logistics company. The big question is it a good time to buy now?
It's a really interesting one. Operates in, trucking, terminals, storage, U.S. and Kuwait.
And the data we looked at, it suggests, well, maybe an attractive entry point after the prices sort of settled down. But yeah, we need to understand what's really going on underneath.
We definitely want to hear from you. Subscribe, like, and comment to support the show.
Absolutely.
And if there's a specific company you want us to look into, please leave it in the comments below.
So let's get into the analysis of this company. When you look at the data, it feels like maybe the market just doesn't quite get it.
Yeah, doesn't get it. Sounds about right.
The growth, the sheer speed of the recent growth, that's really the heart of the bullish case here.
It really is. The numbers are, well, kind of staggering for a business operating where it does, midstream energy, and at this scale. If we just start with the top line, revenue, that acceleration is what really jumps out first.
It does.
Q1 2025 revenue was $37.3 million. Now think about that. That's a huge 133% jump compared to the year before.
Yeah, and like you said, this isn't some tiny startup doubling a small number. This is serious momentum, well into the tens of millions. Hypergrowth, really.
And crucially, it seems like it's not just, buying revenue or just riding oil prices. It looks like it's translating to efficiency.
That's what we need to check. We always look under the revenue hood, right, at the gross profit.
And what did that show?
Well, the gross profit surged 345% in Q1 2025.
Wow, 3.5 times.
Yeah, that kind of jump, even before you factor in overheads and everything, it shows they're getting real leverage from their operations.
Right, so when they push more volume through, their costs aren't scaling up nearly as fast.
Exactly. They're making the most of the infrastructure they already have. That's, textbook scaling for a logistics player.
That's the key, isn't it? And if we look bigger picture, trailing 12 months, the revenue's already hit $124.05 million. So this company is firmly over that 100 million mark, and it's speeding up, not slowing down.
Which brings us to the big puzzle you asked us about. If they're growing that fast, why is the stock price where it is?
Yeah, how can a company with over $124 million in sales have a market cap of just, $17.62 million?
That kind of gap. It's either a massive opportunity or, a huge red flag.
It forces you to pause, definitely.
Yep.
A price-to-sales ratio that low normally signals serious trouble, like maybe bankruptcy fears or the market thinks revenue's about to collapse.
Right.
So you take the $124 million TTM revenue, compare it to that tiny $17.6 million market cap, you get a PS ratio around 0.14x.
Which is just incredibly low. Extremely low.
So the obvious question is, what are the risks the market sees? And are they, overblown?
Well, the sources suggest maybe they are, partly because of the tangible value underpinning the business. It's not just numbers on a page.
Okay, explain that tangible value. What assets do they actually have? What stops this being like smoke and mirrors?
It's their asset base. They own real stuff, hard assets, trucks, terminals. That gives them some foundation.
Okay.
But more importantly, they have specialized things like the Omega gathering pipeline.
Hold on, let's define that quickly. A gathering pipeline. What's that exactly? And why is this Omega one so important?
Okay, think of it like a private toll road for oil.
Yeah.
Producers drill the oil, but they need to get it from the well to the bigger transport lines.
Right.
The Omega pipeline collects that oil from wells in a specific area. It's their system. Once it's built, it's really hard and expensive for anyone else to build another one nearby.
So it kind of locks in the local producers.
Pretty much, yeah, for potentially decades. It's sticky. That gives real tangible value and helps create those reliable recurring revenue streams we like to see.
Got it. So it's not just about moving stuff, it's controlling the choke points, which leads to their competitive edge, maybe? That vertical integration idea?
Exactly. How does that stop competitors? Well, it makes life much simpler for the oil producers they serve. They run two main parts that work together. The trucking logistics, moving the crude oil, and also the produced water, which is a byproduct, and then the terminaling and storage segment.
Ah, so the producer doesn't need one company for trucking, another for storage, another for getting it into the main pipeline.
Precisely. It's like a one-stop shop, but for moving energy. That network, combining the transport and the crucial storage part, makes them really efficient and ideally indispensable to their customers.
And then there's the geography piece.
Right, that's another strength.
Yeah.
They're not just stuck in one U.S. oil field that might boom or bust.
They have operations in the U.S. and Kuwait?
Yeah, that international angle is key. It spreads the risk, obviously, but also opens up growth avenues that smaller, purely domestic players just don't have access to.
Okay, that makes sense. But all this growth, all these assets, it costs money. So how are they funding it? That seems critical for what happens next.
It is, and we've seen two pretty significant financial moves recently.
The first one sounds like a big deal for their capabilities. Back in September, they signed a term sheet for a $40 million commodity intermediation facility. Sounds complex.
It's vital, actually, and the name intermediation gives you a clue. It's not just a standard loan.
Okay.
It lets them essentially take temporary ownership of the oil they're moving and storing.
Ah, okay. So instead of just charging a fee to move a barrel.
They can actually buy the barrel, hold it briefly, maybe hedge it, and then sell it, aiming to capture a small profit margin on the actual commodity itself.
Right, leveraging their logistics position into a bit of trading.
Exactly. It expands their crude oil trading platform. That could seriously boost revenue and, importantly, maybe margins if they manage the trading risk well. That $40 million is the firepower for that new engine.
Okay, that's significant. And the second thing was more traditional fundraising.
Yes, just recently, end of October roughly, they closed a $3.5 million registered direct offering. And notably, it was with a single institutional investor.
Okay, so dilution is always a factor we have to mention with these offerings.
Always. It's the price of growth sometimes.
But this cash gives them immediate working capital. They need it to get that trading platform going and just keep scaling the core logistics side.
Yeah, that capital is pretty much essential if they want to keep up anything like that 133% revenue growth we saw earlier.
All right, let's switch gears a bit. We've talked fundamentals, strategy. What about the stock chart itself? Because despite the good news, the technical picture tells a story of, well, pain.
A lot of pain, yeah.
Yeah.
The stock's trading near $0.29 based on the source date.
And compare that to the 52-week high.
It's staggering. It's down about 82.7% from the high of $1.68.
So the market has just hammered this stock over the last year.
Utterly.
Yeah.
But purely from a technical standpoint, that massive drop could mean it's at a technically attractive entry point if you buy into the fundamental story we just laid out.
And do the technical indicators support that the selling might be overdone?
They do suggest that, yeah. Things like momentum oscillators, SDOCH, for example, it's way down at 16.1 cent.
Okay, for listeners not glued to technical charts, what does SDOCH tell us? Below 20 means?
It's the stochastic oscillator. It basically compares where a stock closed relative to its price range over a set period. Below 20 usually signals it's deeply oversold.
Meaning the selling has been so intense that statistically some kind of short-term bounce is pretty likely, almost regardless of the news flow.
That's the idea, yeah. The technicals are basically screaming oversold.
So if we look at the near-term technical targets, what are analysts suggesting?
Well, some models are pointing towards a 3-month target somewhere between $50 and 75 cents.
That's a big potential jump, 72% to 158% upside from current levels.
Huge potential upside, yeah. Assuming, of course, it manages to break that downtrend technically.
We don't have long to wait for the next big data point, do we?
No, the most significant near-term catalyst is definitely the third quarter 2025 earnings report. That's coming up November 18th.
And everyone will be watching. Did that Q1 hypergrowth continue? What's the update on deploying that new $40 million facility?
Exactly. Plus, you've got other sort of institutional things happening. There's a presentation at the Think Equity Investor Conference, end of October.
A chance for management to tell this story to the money managers?
Right. And then the usual ETF and index rebalancing around December 15th, which can sometimes move these smaller stocks around quite a bit.
Okay. We've laid out a pretty strong case based on growth and that rock bottom valuation. But we absolutely have to talk about the risks. Why has the market punished this stock so severely? Because this is clearly high risk, high reward.
Absolutely. Risk number one, and it's the elephant in the room, really.
Yeah.
Profitability, or lack thereof.
Right. For all that amazing revenue growth, $124 million trailing 12 months, the company is still losing a lot of money.
Deeply unprofitable, yeah. The sources showed a trailing 12-month net loss around minus $40.96 million.
That's a big negative number. You can't just brush that aside.
You can't. And those ongoing losses put pressure on the balance sheet. Until they can show a clear, sustainable path to actually making money, net income, the market's likely going to keep that PS ratio down near 0.1 vol X, basically pricing in distress.
regardless of the top-line growth.
Pretty much. Yeah. The real long-term prize here is hitting profitability. Analysts are watching for that maybe sometime in 2026. That would be a fundamental game changer.
And that profitability issue leads straight into risk number 2, capital and dilution.
Yep, it's the growth trap. Growing fast costs money for inventory, operations, buying assets. We just saw that $3.5 million offering. Necessary, maybe, but
It dilutes existing shareholders.
it does. And if they need more cash before they turn profitable, shareholders face more dilution. Yeah, that can really wear investors down and keep a lid on the stock price. You have to watch their cash burn like a hawk.
Definitely. And risk number 3 is just the nature of the beast. Small cap volatility.
Yeah, especially when it's got this kind of distressed valuation on top. Market cap only $17.6 million. Stocks like this can swing wildly.
Liquidity can be an issue too, right?
Oh, absolutely. The numbers show it. The 30-day volatility is super high, 37.70%. You need to be ready for big moves, up or down. Doubling or halving isn't out of the question. And getting in or out quickly with a large position can sometimes be tricky.
So it really boils down to 2 competing narratives, doesn't it?
It does.
On one hand, you've got undeniable, super fast growth, strategic assets like that Omega pipeline, and a valuation that just looks crazy cheap on a sales basis.
Almost offensively cheap, yeah.
But on the other hand, you have these significant losses, the constant need for capital raising dilution concerns, and the inherent volatility. That's why the stock's down 80%.
The whole investment case really hinges on management.
Yeah.
Can they execute? Can they actually use that new $40 million facility effectively to start generating profitable trading activity, not just more revenue?
It's all about execution now.
It is. But the potential payoff is huge because of that asymmetry, that gap between the 0.115 PS and the 133% growth. It presents a genuine high-risk, potentially very high-reward situation.
It's a fascinating setup. So for you, the listener, the decision comes down to, do you believe this management team can make the shift? Can they pivot from just growing revenue to actually delivering sustainable, profitable growth over, say, the next year or 2?
And maybe here's a final thought to chew on. Forget complicated models for a second. If this company could just trade at, say, 0.5 times price to sales, which is still incredibly cheap for a logistics company showing any kind of growth,
Yeah.
that alone implies a potential return of nearly 300% from where it is now, just by closing some of that massive valuation gap relative to its actual revenue. It's not based on hype, just on getting a slightly more reasonable, though still low, multiple. The real question is, how much bad news is already baked into a stock trading under 0.15 times sales?